Hello everyone, I hope you guys are doing well and studies are going in full swing. In today's video, we would be covering the entire all-important IND 21 on foreign exchange along with the important questions. So let us get started. Now this is a standard which deals with foreign exchange transactions and it is similar to AS 11 that you might have done in your CA intermediate. Now the standard has three main parts. First, identifying the types of currencies. Second, what are the principles for converting the transactions that have happened in foreign currencies? And third, if I have a foreign operation and if I need to translate the financial statements into my currency, what are the principles that I need to follow? So let's get started. First of all, when I look at the types of foreign currencies or types of currencies, there are three types of currencies over here. First is a functional currency. This is defined as a currency of the primary economic environment in which an entity operates. Now, usually the natural thought process is that if I'm an Indian company, my domicile, that is India, would define my currency, that is rupees. Now, as per IND 21, that is not necessarily the case. Where you are registered does not really matter. The primary economic environment in which you operate is what matters. Like in income tax, a lot of times what happens is a lot of companies set up their offices in Mauritius for tax reasons and they invest in India. They might have a registration in Mauritius, however the primary economic environment is the Indian environment. So standard over here believes that functional currency refers to the currency of the primary economic environment in which you operate. And the significance of the functional currency is when you are preparing your books of accounts, your tally, SAP, whatever it is, your transactions will be recorded in the functional currency. Like if I'm an Indian company dealing with Indian customers, my currency is the Indian rupee, and as a result over here I will record my transactions in rupees. However, if I were to deal with, let us say, European customer and my invoice is in euros, I'll have to convert the euro invoice into rupees because all my transactions have to be recorded in the functional currency, that is the currency of the primary economic environment in which I operate. So what is a foreign currency? Every currency which is other than a functional currency is defined as a foreign currency. So if for you the functional currency is the Indian rupee, then every other currency, the yen, the euro, the dollar, everything is a foreign currency. And if you do a transaction in the foreign currency, you'll have to convert it into the Indian currency at the prevailing spot rate. Okay, so every currency other than the functional currency will be defined as a foreign currency. Transactions in the foreign currency need to be converted, and what are the rates to be used is what we will study across the standard. And thirdly, what is a presentation currency? Now, usually you will present your financials in the functional currency. So if you are an Indian company who is preparing in rupees, you'll present your financials, balance sheet, P&L, etc. in rupees. However, let us say your parent is Coca-Cola USA, you are Coca-Cola India Private Limited, and you believe that it is very helpful if the parent sees my financials in dollars. Now, my primary economic environment may be the Indian environment because I'm selling Coke bottles to Indian people. I have a factory in India. My employees are Indian. So my functional currency is a rupee. However, I might want to present the financials in dollars, and hence my presentation currency may be something which is different. So presentation currency is a currency in which the financial statements are presented. Now, all of this hinges on your understanding of what is a functional currency. Now, usually functional currency, the standard gives you primary factors and then additional factors. When we look at the primary factors, there are three primary factors. The currency which influences the environment in which you are selling. So if your sales are influenced, for example, by the rupee pricing, then that is taken for you. Second, what is the currency which influences the expenses? And third is the currency of the environment in which you operate. Like if I'm a coaching institute in India, for me I sell to Indian students and hence my sales are usually influenced by rupees. My expenses like rent, faculty cost, etc. is also in rupees, and my competitors and the regulators are also in India, and hence for me clearly India is my primary economic environment and hence my currency will be the Indian rupee. However, if I'm running a BPO operation where I'm selling largely to US customers, however my expenses are largely in rupees and my competitors are mixed, they are global, in which case there's a conflict. If there is a conflict, then I will go to the additional indicators, that is the currency in which I'm raising money, the sources of finance, and the currency in which I'm retaining the money. So if I'm an Indian company, though I'm operating in the US environment for selling, however I'm retaining money in the Indian rupee largely, or I am actually raising money if required from Indian banks in rupees, in which case, looking at the additional factors, I can conclude that rupee is my functional currency. However, I will go to these additional factors only if the primary factors are not conclusive. If the primary factors give me a conclusive verdict, I don't even need to go to the additional factors. Now, in my primary factors, the standard says currency which mainly influences the sales. What do you mean mainly influences? Does that mean that the currency in which the sales are denominated? Well, generally yes. However, sometimes the sales are denominated in a particular currency merely for the purpose of convenience. Like if you were to buy an airline ticket from Lufthansa, you will still see the prices in rupees. However, Lufthansa has determined the price in euro, and at every day they are converting into rupees for your convenience, in which case the currency which influences the sales is actually the euro. In a similar way, when we look at, for example, certain transactions which could have been denominated in rupees, however, I have some import commitments which I have to pay in dollars. So I say that in order to match that, in order to hedge it, then I'm pricing my sales in dollars so that I can get a dollar receipt and pay it off for a dollar payment. And hence, this is for hedging. All of these are considered to be are not considered to be relevant. So your denomination is not considered to be relevant. The currency which is the underlying currency based on which the pricing is determined is the relevant currency. So over here, as we say, emphasis should be given in the currency which determines the pricing and not necessarily the currency in which it is denominated. Sometimes it may be priced in rupees just for convenience or for the purpose of hedging, in which case one needs to remember that you always hedge the foreign currency and not your local currency. And further, denomination should be done based on the primary indicators. However, if there is a conflict in the primary indicators, only then will you go to the additional indicators. Okay, we'll go to the questions in some time, but before that, we'll review the conversion and other principles. So when you're looking at the second part of the standard, first is the theory part. To be honest, it is highly subjective and hence it has not made it to the main exam, at least the first part of functional currency, because you'll have to look at the facts of the case and then determine the functional currency. There are a few questions in the study material. Having said that, from an exam perspective, it is relatively less important. What is most important from an exam perspective is the principles for converting a foreign currency transaction. Now, when you're looking at a foreign currency transaction, it can be an import transaction, it can be an export transaction, anything. Here, let's say you are an Indian company who has exported goods to the US, in which case, on 1st January 25, if you have exported the goods, you will convert this into the into rupees at the spot rate or the exchange rate prevailing as on the date of the transaction. Your entry will be debtors account debit or cash account debit to sales. Over here, this will be converted at the exchange rate prevailing as on the date of the transaction. So on 1st January, if the exchange rate is 80 rupees per dollar and you have made $1,000 sales, your entry will be bank account debit if received or debtors account debit if yet to receive 80,000 to sales, let us say 80,000 at the rate on the date of the transaction. Now, the P&L one needs to be remembering is for the entire year. However, the balance sheet is prepared as on date. So when I look at the P&L for the year 24-25, in that the transaction on 1st January 25 will appear as sales as 80,000. However, the balance sheet is prepared on 31st March 25, and hence when you prepare the balance sheet, you'll have to segregate the items between monetary and non-monetary. What do you mean by monetary items? Monetary items are those items where there's a, in a way, contractually fixed or determinable amount. The money that you're going to receive for an asset or pay for a liability is contractually fixed or determined in money value terms. Something like debtors, if the balance is 22,222, I receive exactly that, not a penny more, not a penny less. So debtors are monetary. Same is the case with creditors. And also cash, bank balances, etc. I receive exactly what is the money value. However, when I look at land, when I look at building, when I look at patents, goodwill, all of these items, the value appearing in the balance sheet does not give you a contractually fixed or determinable amount. Undoubtedly, they might give me future economic benefits, but they cannot be converted into contractually a fixed or determinable amount, and hence these land, building, machinery, patents, copyrights are all treated as non-monetary. So when you look at a non-monetary item, we'll come back over here, but when you look at a non-monetary items which lack the right to receive or obligation to pay a fixed or determinable amount of currency is called as a non-monetary item. And the students usually have this wrong presumption. They kind of make this rule somehow that a current item is usually monetary, a non-current is non-monetary, which is wrong, which is not necessarily the case. Like for example, when loans, if there's a 10-year loan, I exactly know what is going to be paid in fixed money value terms, and hence loan, even though long term, is a monetary item. On the other hand, when I look at inventory over here may be a current asset. However, I might have a $100 inventory. I'm not very sure how much am I going to receive. My NRV may be more. I've not really sold the inventory, and hence inventory is a non-monetary item. In a similar way, items like unearned revenue, like I might have received the money, however I'm yet to give the service. What I have to give is the service, not the money, and hence it is not a monetary item, it is a non-monetary item. So we have discussed a few examples over here. For monetary, trade receivables, trade payables, expenses payable, cash and bank balances, investment in bonds, loans taken, loans given, all of these are fixed or determinable money value terms. Monetary items. Non-monetary, land, building, machinery, patents, copyrights, inventories. The amount to be paid or received is not fixed in the monetary value terms, and hence it is non-monetary. This is very important for segregation and finding the relevant rates, because at the balance sheet date, if your item is a monetary item, then Ind AS 21 says that you will have to convert this at the closing rate. Like debtors, in our example of credit sales, $1,000 at 80 rupees was on 1st January. Now this money is still not received. Now the rate is 85. Now, as on balance sheet date is like a snapshot selfie of the company, and hence on 31st March, if the debtors are still $1,000 and the rate is 85 rupees per dollar, and hence in fixed money value terms, I'm going to get $1,000, which is now worth 85, and hence you will remeasure the debtors to the closing rate. Debtors account debit by 5,000 to foreign exchange gain, which can be taken in the P&L at 5,000. This is an adjustment that you will have to do for monetary items, and if there's any foreign exchange gain or loss in the monetary items, whether it is realized or unrealized, will be taken into the profit and loss account. Now, when we look at non-monetary items like land, for example, non-monetary items which are measured at historical cost. Let's say you bought a plot of land in New York on 1st January 25 at the rate of $1,000 when the rate was 80. You must have assumed land account debit to bank or to payable as a case, maybe at 80,000. Now, as on the balance sheet date, let's say land is still appearing at $1,000. However, the closing rate is 85. The standard says non-monetary items which are to be shown at historical cost will be kept at the historical rate only. Why? Because as on the balance sheet date, your land is not necessarily worth $1,000. For debtors, $1,000 means I'll receive exactly 1,000, not a penny more, not a penny less. But for land, you might receive more than 1,000, less than 1,000, and hence the logic over here is if your land itself is based on a value which is not fixed or determinable on 31st March, any foreign exchange gain or loss, if you calculate based on that value, is not reliable. If your land itself is not sure to give you $1,000, then how can the gain or loss based on that land be recorded? And hence non-monetary items which are to be shown at historical rate will be kept at the historical rate only. You will not remeasure it at the closing rate. However, if it is a non-monetary item which is to be remeasured, then for example, land of $1,000, you remeasured it to $1,200 when on 20th February. Then you will remeasure the land on the rate, on the date when fair value was decided. If fair value is on 20th February, you will remeasure the land on the 20th February rate. Acha, where will the difference go? Well, we will see that. However, you will remeasure the land, which is a non-monetary item, because the balance sheet value now is a $1,200 land, which is what 20th February, then the rate also should be on 20th February. Are we clear with this? So the rule over here is subsequent recognition in the balance sheet for non-monetary items which are shown at historical cost, we'll keep it at the historical rate. Whereas if they are at fair value, you will show them at the rate on the date when fair value is determined. Monetary items will always be kept at the closing rate only. Long story short, as on the foreign exchange conversion principles, when you do the transaction, you will take the rate as on the date of transaction. Sometimes you might even take the average rate. Then at every balance sheet date, monetary items will have to be remeasured at the closing rate. Non-monetary items which are kept at historical cost will be at the historical rate, whereas non-monetary items which are to be taken at fair value will be on the rate on the date when fair value is determined. But sir, where will the second effect go for all of these items? Before you proceed over here, the second effect over here for all the monetary items, if there's any foreign exchange gain or loss, again realized or unrealized on monetary items, they will always go to the P&L. Remember, always to P&L. An example of a monetary item can be a debtor, creditor, loan, and even investment in debentures, because you're going to get a contractually fixed or determinable amount, and as a result, investment in debentures is also a monetary item. And hence, if there's any foreign exchange loss, if you have invested in a foreign debenture or a gain, that will also go to the P&L account. This is irrespective of whether the debenture was classified as as amortized cost or at FVTPL. We'll do detailed problems for this. Okay, so this is regarding investment or any monetary item. But for non-monetary items, the standard says that non-monetary items, first of all, which are kept at the historical rate, in that case, there is no gain or loss. However, if the non-monetary items are remeasured, then there will be a gain or loss, foreign exchange gain or loss. Where will this go? Well, it depends on when the underlying gain or loss is going. Like when land is revalued from $1,000 to $1,200, there's a $1,200 revaluation gain, which will convert at the appropriate exchange rate. But where will that go? So it will go to the revaluation reserve as a part of OCI. If the underlying fair value gain is going to the OCI, then the foreign exchange gain, if any, will also go to the OCI. I'll again repeat. if the non-monetary items is to be recorded and the underlying gain or loss is going in the OCI, like revaluation, underlying gain or loss is going in the OCI, in which case any foreign exchange gain or loss will also go to the OCI. Okay, so sir, how will we do that? Well, there is an example over here. We'll do a detailed numerical as well. If land on 1st January was $100, on 31st March becomes $120. So there is a gain of $20, keeping the exchange rate constant. So had the exchange rate not changed, it would have remained 50 only. Still there's a $20 gain. $20 into 50 will come to, let us say, 1000 rupees. So land account debit to revaluation in the OCI will be 1000. However, has the exchange rate also changed? Well, yes. So the exchange rate has changed from 50 to 60. So there's a 10 rupees appreciation on the exchange rate, which is to be multiplied by $120. Why? The original $100 was at 50. The remaining $20 of gain also you recorded based on 50, and hence the entire $120 you will multiply, for example, by 60 minus 50, that is equal to 10, and hence that will be 12,000. So your entry will be land account debit to revaluation in the OCI, that will be, let us say, 10,000, and to foreign exchange gain, which is also going as a part of the revaluation in the OCI, which is, for example, over here 1200, and hence your land will be debited, and corresponding to that you will have revaluation reserve, and secondly, even the foreign exchange gain will go to the OCI. Why? Because this is a foreign exchange gain on the land whose gains or losses are to be taken into the OCI. Then the revaluation gain will also be taken into the OCI. Okay, the only exception to this rule is if I were to invest in equity shares which are at FVOCI, then the fair value gain or loss of these investment in equity shares which are non-monetary in nature will go to the OCI. However, as per a specific instruction of IND AS 109 as well as IND AS 21, the foreign exchange gain, if any, will be taken to the P&L. So when we look at non-monetary items, if the underlying gain or loss is going in OCI, and if it is investment in equity shares which are shown at FVOCI, the gain or loss will go to the P&L because there is an exception. However, for other cases like PP using revaluation model, the gain or loss will go to the OCI. Then the foreign exchange impact will also be taken against the OCI. For other items like investment in equity shares which are recorded at FVTPL, or biological assets which are recorded at fair value less cost to sell, these are non-monetary items and their gain or loss is going to the P&L, then their foreign exchange gain or loss will also go to the P&L. So for all other cases, biological assets, foreign exchange gain or loss in the P&L, because the underlying gain or loss is also going to the P&L. And if the non-monetary items are get to the historical rate, there is no forex gain or loss at all. So if I have to quickly summarize in a nutshell, the treatment on foreign currency conversion at the rate as on the date of the transaction, you will take the spot rate on that date. At the balance sheet date, you will remeasure monetary items at the closing rate. Gain or loss, if any, will always, without any exception, go to the P&L. Non-monetary items, you will keep at the historical rate if they are shown at historical cost, in which case there is no foreign exchange gain or loss. However, if non-monetary items are to be shown at fair value, then there will be a remeasurement based on the rate on the date when fair value was determined. The difference, if any, will go to the OCI if the underlying gain or loss was going to the OCI, will go to the P&L if the underlying gain or loss was going on the P&L. However, the exception to this would be if it is investment in equity shares at FVOCI, then the foreign exchange gain over here will go to the P&L, though the underlying gain or loss may go to the OCI. Further, if there is investment in bonds, even if they are recorded at FVOCI, their gain or loss will always go to the P&L because these are monetary in nature. Let their fair value gain or loss go to the OCI, but their foreign exchange gain or loss will always go to the P&L. We will do sums on this so that you will get a better understanding. Okay, so as you have mentioned over here, foreign exchange gain or loss will be usually taken to the P&L. Ajay, now there are certain special cases over here as well, like what happens if I have to compare the cost with the NRV to decide the balance sheet value. Like for inventory, at each balance sheet I'll have to compare the cost with the NRV. For example, if the cost of the inventory was $100, when you purchased, the rate was 50, and hence the total cost in rupees is 5,000. But the NRV at the balance sheet date is $90 when the rate actually is 60. In which case, over here, the rupee balance is 5,400. So the challenge over here is, what do you guys think? Will I put the write-off looking at the dollar balances or rupee balances? Well, the standard says rupee balances. in dollars, I might show that I'm getting $10 less. But how does it matter? In my balance sheet, I had shown that this asset is worth 5,000. It is capable of giving me 5,400. So there is no write-off. And hence, for deciding whether there's a write-off or not, whether it is inventory, Ind AS 2, or even Ind AS 36, where I have to compare the carrying value with the recoverable value, I will first convert everything at the appropriate rates, find the carrying value in rupees, compare it with the recoverable value in rupees, and then if the rupee value is lower, that is when there will be an impairment. Okay, a very important thing over here will be the application of Ind AS 21 in amortized cost as well as FEOCI. Now what happens is, when you look at Ind AS 21 in amortized cost, for example, you have invested in a bond which is recorded amortized cost, or you have issued a bond or given a loan or taken a loan which is measured at amortized cost. Now if this loan is given in dollars, remember, there is a contractually fixed or determinable amount to be paid or received in dollars, not in rupees, in dollars. So if there's a loan of, let's say, if there's a loan which is taken or given of $8,863, coupon rate is, let us say, 7%, effective rate is, let us say, 10%. I will say that if the face value was 10,000, then in such a case, my opening balance will be 8863. If the 10% is the effective rate, 10% of 8860, that is 886, will be my effective interest in dollars. Coupon 10,000 into 7%, that will be 700 received in dollars, and hence I'll get a closing, let us say, as 9049 in dollars. I've just jotted out the numbers, but essentially my amortization table has to be prepared in dollars because I'm going to pay or receive the dollars. And this amortization table will then be converted into rupees. What are the rates that you will use for converting this amortization table in rupees? Well, the opening balance will be converted at the opening rate. Interest accrues throughout the year and hence will be converted at the average rate. Coupon on the rate on the date when coupon is paid, the payment usually which is at the end of the year, so closing rate. And then you are going to be left with the dollar balance. Now this dollar balance is a closing balance which is for a monetary item, and hence this will have to be converted at the closing rate. Now the thing is, when you convert this table into rupees, you will see certain balances being converted at the opening rate, certain at the average rate, certain at the closing rate. So if this amortization table was tallying in dollars, will it necessarily tally in rupees? The answer is no. Why? Because you have taken different rates for converting different items, and hence the balancing figure, if any, which arises is due to the foreign exchange impact, and hence the balancing figure will be the foreign exchange gain or loss which will go to the P&L account, because these are loans taken or given which are monetary items, and hence their forex impact will always go to the P&L. In fact, even if you were to invest in bonds which are at FEOCI, the balancing figure over here, which is arising due to differences in exchange rates, will go to P&L because it's a gain or loss on monetary items will have to be taken to the profit and loss account. Is it possible that these bonds are FEOCI bonds? Well, yes, in which case the same working will apply till this column. However, additionally, this is the closing amortized cost. Now we'll have to compare the closing amortized cost with the closing fair value, and we'll do sums on this. Closing fair value, and if there's a difference, that is a fair value gain, which will go in the OCI, fair value reserve as a part of OCI. Now, the foreign exchange gain will go to the P&L, but the fair value gain is as per Ind AS 109, and if 109 says it has to go to the OCI, well, it has to go to the OCI. So the above treatment will remain the same for bonds at OCI. Additionally, two more columns will be needed: fair value reserve and closing fair value. So long story short, if you were to kind of sum up what we have discussed, and we'll do sums on this before we go to the next section, is if there is a loan given or taken which is recorded either at amortized cost or FEOCI, then you will first prepare the amortization table in dollars. Then every item you will convert in rupees at the appropriate rate. And then if there's a balancing figure, that balancing figure is attributable to the foreign exchange gain or loss. Now this is up to amortized cost. If there's also FEOCI, then you'll have another two columns for a fair value reserve as well as the closing fair value, and the balancing figure over here will be recorded as per Ind AS 109. That is, if it is a fair value gain or loss, it will go to the fair value reserve as a part of OCI. And the last part, before you go to the foreign operations section, is what if revenue is against goods which are going to be delivered in the future, but we are going to receive advances. If you receive money in advance, like unearned revenue, then you will record the revenue based on the rate on the date when these advance installments were received. Like you might receive $100 on 1st January, then another $100 on 1st February, then another $100 on 1st March, and then you deliver the goods on 31st March. Now in this case, you have already received the money in rupees, Well, you have received the money on 1st January, 1st February and 1st March, and hence you will convert it at the rate prevailing on those dates, and that will be your total base for revenue. You will not remeasure these amounts. You must have passed your entry bank account debit to unearned revenue, bank account debit to unearned revenue. Now you are under an obligation to give service or goods. You're not under an obligation to give money, and hence Ind AS 21. The appendix clarifies that this is a non-monetary item, and hence this will be at the historical rate. You would have converted the first $100 at the rate of on 1st January and kept it in rupees. Another $100 on 1st February, kept it in rupees, and hence your total revenue will be the sum total of those amounts without any remeasurement. Again, we'll try to do questions pertaining to this. So let us go to the questions for Ind AS 21. Question 1 and 2 are on functional currency. Just for reference, we'll review question number 3. It is a case-based question, not very important, but for functional currency, this can give you a good sense. Okay, so S is a company based out of India, got listed on the BSE in the year 31st March 11. Since the company's operations have increased considerably, the company was engaged in business of trading of motorcycles, and the company only deals with imported motorcycles. These are imported from the US. So there is a distributor, like we are Harley Davidson motorcycles that we are importing from the US and maybe distributing it in India. After importing the motorcycles, they're sold across India through various distribution channels. The company had only private customers earlier, but the company now has started corporate types and increased the customer base to corporates as well. So like Zomato, Swiggy, Zepto, I mean, I know they don't use Harley Davidsons, but nevertheless, I've tried to type with corporates as well. The purchase of motorcycles are in USD because a vendor from whom motorcycles are purchased are all located in US. So over here, when you look at your expenses, a part of your expense is in dollar for import of motorcycles, but all other operating expenses are incurred in India only in rupees. So there's a mix. One expense is in dollar, maybe a major expense, but all other major expenses are in rupees because of its location, and they generally happen to be in INR currency. Its customers are both corporate and private in the ratio of 70-30. The USD denominated prices of motorcycles in India are different from those in other countries. So can I clearly say that the Indian environment is different from the US or every other environment? So over here, when I have to identify functional currency, I have to figure out the currency which influences the sales, the currency which influences the expenses, and the economic environment. It seems that the prices of the motorcycles in India are different from other countries, and hence the Indian environment is unique, is different. And hence over here, there is clearly an Indian environment. The company is also expecting that in the coming years, customer base will increase significantly in India, and current proportion may also change. So current proportion, whatever it is, that will change. Currently, the invoices are raised to corporate customers in USD. Acha, why are they raised in USD? For the purpose of hedging. Acha, do you hedge the home currency or foreign currency? Usually the foreign currency. So over here, maybe I have to pay dollars for importing the motorcycle. So I need to arrange dollars. So for that, I'm denominating in USD. Otherwise, I would not have denominated in USD. So over here, I'm pricing these in USD for the purpose of hedging, not otherwise. However, private customers don't accept the same arrangement, and hence invoices are raised in rupees. So everything is mixed over here. What is the functional currency of this company? Well, for functional currency, you will determine the currency which influences the sales. It seems that corporate customers are in USD, but that is for the purpose of hedging. If I had no import commitment to pay in USD, I would not have billed them in USD, and hence the currency which influences the sale price is the rupee. Expenses are largely rupee expenses. There is import of motorcycles in USD, but that is usually hedged because I'm going to receive money from corporate customers in USD, use it to pay the motorcycle cost, and hence all other expenses are in INR only. And the environment in which I operate is the Indian environment, and hence the functional currency over here seems to be INR. Now, I can fully appreciate that this is a highly subjective answer, and you can always draw out different conclusions as well. Having said that, this is what the institute has done, and which I believe is reasonable as well. And because of the high degree of subjectivity involved, institute usually does not ask you questions involving identification of functional currency, and if they do, they will generally be a lot more direct. Now, what is very important now is question number 4. This is one of Institute's top favorite questions and has come multiple times in your exam. So let us review this once. On 30th January 11, A Limited purchased a machinery for $5,000 from US as supplier on a credit basis. So this is on credit, and hence you will pass the entry purchases account or machinery account debit to payables. Okay, just a second. Yeah. So machinery account debit to payables is functional currency is a rupee. So you will have to convert this into rupees. The exchange rate on the date of the transaction is rupees 60 per dollar. So 5,000 into rupees 60 will come to around 3 lakhs. So your entry will be on 30th of January 11 machinery account debit to payables at 3 lakhs. The fair value of the machinery is determined on 31st March 11 at $5,500. Now, usually, if machinery is measured using the cost model, I don't need to find the fair value. If the fair value is given, then probably you must be following the revaluation model. And if you are following the revaluation model, then the machinery worth 5,000 is now moving to 5,500, and hence there is an increase of $500. Acha, that is the difference between 5,000 and 5,500. Had the exchange rate remained constant at 60 rupees, still there would be an increase of $500 into 60. That comes to what? 30,000. Acha, where will this 30,000 gain go? Well, as per Index 16, this is a pure revaluation. Had the exchange rate remained constant, still from 5,000 to 5,500, there is a $500 increase in the value of the land, keeping the exchange rate constant. So this is 30,000 going in the revaluation reserve. The exchange rate on 31st March 11 is rupees 65. Now, originally the 5,000 was recorded at 60. The additional 500 also you recorded at 60. And hence, if I have to measure the foreign exchange impact, I will say that, well, rupees 65 per dollar minus rupees 60 per dollar. And hence that is 5 rupees per dollar into 5,500. And hence this will probably come to 27,500. This is also an increase. So your journal entry over here will be land account debit. If I can just pull this up. Initially, your entry will be machinery account debit to payables. Then, if machinery is recorded using the revaluation model, you will say machinery account debit to revaluation, which is a part of OCI, and even the foreign exchange gain over here will go into the revaluation, which is a part of OCI, and hence your machinery will increase by 57,500. So does that logically make sense? Well, if you take 5,500 on your calculator and multiply it by 65, you get exactly 357,500. That is, your machinery, which was earlier 3 lakh, will be taken up to 357,500, out of which 30,000 is pure revaluation gain. Another 27,500 is foreign exchange gain. However, because it is on non-monetary item, it will also be taken to the revaluation in the OCI. Okay, now this is regarding machinery. However, did you also have a payable? Well, I had done a credit purchase, which means I also had a payable. Now, payable is a monetary item. And this is the payable of 5,000. Let the fair value be 5,500 or whatever. The payable is 5,000. And I thought I'll have to pay 5,000 into 60. Now I have to pay 5,000 into 65. And hence there's a 5 rupees increase. That is a loss. And hence payables will be credited. Forex loss will be debited in the profit and loss account. So this is Forex loss account debit. 5 rupees into $5,000. That is 25,000. And that's about it. Okay. So this is regarding the year 10-11. The payment to overseas supplier was done on 31st March 12. That is a year later. Not in 11, in 12. When the exchange rate was rupees 67 per dollar. Now in the next year, if the exchange rate is 67, your entry will be payables account debit. You have recorded at 3 lakhs, the payable, and then credited another, I think, 25,000 for the payables. And hence, the payable will now be 3,25,000 to bank. When you are paying, this is 5,000 into, I think, 67, and hence you are paying 3,35,000 when the rate on 31st March 12 is 67, and hence you are paying 3,35,000. The additional 10,000 will go to the profit and loss account as foreign exchange loss. So over here, if I go over here, payables on 31st March 12, account debit 325 to bank 335 and 10,000 loss. Now things would have been manageable. The fair value of the machinery remains unchanged for the year ended 31st March 12. Now the language appears that you actually did a fair evaluation on 31st March 12, and by the way, it came to 5,500. It is not mentioned that you have not done any revaluation. It is clearly given that the fair value remains unchanged, which means you actually went out, did a fair evaluation, found on 31st March 12 that the fair value is 5,500. Earlier also it was 5,500, and hence there is no appreciation. However, now this is 5,500 on 31st March 2012, and hence you'll have to record it based on the exchange rate as on 31st March 2012. Well, earlier it was recorded at 65. Now it will have to be recorded at 67, and hence rupees 2 per dollar into $5,500 will be 11,000. Again, because the underlying gain or loss on this machinery would have gone to the revaluation, here also this foreign exchange gain in the second year of 11,000 will also go to the revaluation. So your entry in the second year will be machinery account debit 11,000 to revaluation reserve as a part of OCI, again 11,000. Past journal entries for the year ended 31st March 11 and 12. And then comes the lethal thing. Tax rate is given as 30%. Now, what is the objective of giving you that? Well, they want you to check for deferred tax impact. Now, Institute has assumed across everywhere where this has come that the differences on the machinery are temporary differences which will give rise to deferred tax. However, when you look at payables, we can also assume that payables there may be differences. But maybe Institute is assuming that on payables, both books and income tax record the loss of 25,000 in the first year and 10,000 in the next year, and hence there's no difference per se. But in machinery, revaluation is definitely not recorded in income tax, and hence what will you do? We will first take for machinery in the first year the Ind AS value. As per Ind AS, can I say the machinery is worth 3,57,500? Well, land was recorded or machinery was recorded at 3 lakhs, and then another 57,500, and hence this comes to 357,500. Income tax, nothing will be recorded of this sort, and hence income tax base will remain at 3 lakhs. So difference over here is 57,500 into the 30% tax rate will give you a deferred tax liability. Why? Because the carrying value is greater than the tax base. The answer is opposite. The logic over here is 57,500 of gain is recorded in the books. Income tax is not yet recorded, but later, let's say there was a sale, then income tax will record a 57,500 gain, and hence this will result in higher tax payments in future years, and hence a deferred tax liability. Your entry over here will be for deferred tax. Usually deferred tax expense account debit to deferred tax liability, and these expenses go to the P&L. However, this tax is arising because of 57,500 which has gone into the revaluation, and hence can I say the tax impact on that will also be adjusted against the OCI, that is against revaluation, and hence 57,500 into 30% comes to 17,250, and this will be a DTL. Your entry over here will be revaluation surplus account debit 17,250 to DTL. Why? Because the 57,500 is appearing in my OCI, so the tax impact on that should also appear in my OCI. Okay, when you go to the year 31st March 12, again my machinery comes to around 3,68,000. 3,68,500 I think. Compare that with 3 lakhs. Sir, how 368,500? Well, there's no depreciation data given. However, the machinery increased by 11,000. So 3,68,500. Alternatively, you can directly calculate this as 5,500 into 67 comes to 368,500. In income tax, it is still 3 lakhs, and hence the difference of 68,500 into tax rate will come to 2550. I will not pass the entry again for the entire 2550 because I already have a DTL of 17,250, and hence the difference of 3,300 in the DTL will be recorded. So 2 DTL will be 3,300. Over here 2 DTL will be 3,300, and the debit will go against the revaluation. Why? Because this is again due to the difference of 11,000 in the current year which has happened in the revaluation. So this is one of the best questions in this chapter because a lot of standards, PP standard, foreign exchange standard, deferred tax standard, absolute classic, where Institute loves asking you, and it has asked you questions like this on multiple lines, and that you should be able to solve. Now, question number 6 is on that it's not very important, but over here in question number 6, you have received money in advance. Like supplier A enters into a contract with customer B on 1st January 18 to deliver goods for a total consideration of 50 million. Receives an upfront payment of 20 million on that date. When? 1st January. Receives 20 million. The functional currency is the INR, and goods are delivered and revenue is recognized on 31st March 18. So the performance obligation gets discharged on 31st March 18. That is the date when revenue gets recorded. 30 million is received on 1st of April 18 in full and final settlement on the very next day. State the date of transaction for advance consideration and recognition of revenue. Also state the amount of revenue in INR to be recognized for revenue, and the rates are on 1st January and 31st March 72 and 75. So basically on 1st January when you receive the money, you have received 20 million when the rate was rupees 72 per dollar, and hence this will be 1440. This is bank account debit to unearned revenue, and you will not remeasure it. Further on 31st March when the goods are delivered, for the remaining 30 you will recognize, but this is when the rate is 75, and hence 13 to 75 will be I think 2250, and hence if I take the total revenue 2250 plus 1440, this will be 3690. I cannot remeasure the 1440 which was based on the rate on 1st of January. Question number 6. Achha, now when you look at question number 7, this is the all important question because over here Index 109 is kind of triggered. As at 1st April 11, makers raised a loan, that is, they took a long-term loan from foreign investors. The investors subscribed for 6 million FCY loan notes at par. So the investors paid us. So for me, this is a financial liability. I have an obligation to deliver cash. And this is a liability recorded using amortized cost principles. Okay, it incurred incremental issue cost of 5 lakhs. For financial liabilities at amortized cost, if it is a liability, issue expenses will be deducted and hence 60 lakhs minus 2 lakhs, that is 58 lakhs, will be the value at initial recognition. Now the interest of 6 lakhs is payable annually on 31st March, starting 31st March 12, and the loan is repayable in foreign currency on 31st March 17 at a premium. They have not told you what premium. And the effective annual rate of this loan is 12%. Okay, the appropriate measurement basis for this loan is amortized cost. They have given you this. Even if not given, this would have been amortized cost, and the relevant rates on 1st April 11, 2.5, 31st March 2.7, and the average rate 2.42 is given. The functional currency is INR, and you need to calculate all the items: opening balance, closing balance, foreign exchange rate, etc. Now if I look at the amortized cost table in FCY, in year 1, your opening balance will be around 58. EIR on this at the rate of 12% will be around 58 into 12%, I think 6.96. Coupon would be minus 6, and hence your closing will come to probably 58.96. Now what will happen is I'll convert every of these items. This is in FCY, 58, 6.96 minus 6 and 58.96. I'll convert this at the appropriate rate. Like the opening balance will be at 2.5. Interest will be at 2.42. Coupon on the rate on the date when it is paid may be at 2.7. And even the closing balance at 2.7. Now if I convert all of these into rupees, this will be your opening multiplied by 2.5, interest at 2.42, coupon at 2.7. Now if I do this working, I will get a closing balance which will be different from the balance calculated at the closing rate. And hence the difference, if any, is because you are sometimes applying 2.5, sometimes applying 2.42, and sometimes 2.7. And hence that cumulative difference is 13 lakh 54,880. Where will this be taken? Well, my liability is increasing. This, if you total up, comes to around 145 and something. My liability is increasing from 145 to 159, and hence I will credit the liability. So I'll debit the P&L. This is forex loss. Will go in the P&L because it is a monetary item. Are we clear with this? Okay, so this is a forex loss to be taken to the P&L because it arises on account of a monetary item. Okay, we'll come back to this section, but before that, there is a question number 15 also on similar lines, which is important, which is investment in bonds at FEOCA. So over here, question 15, an Indian entity whose functional currency is a rupee purchases a USD denominated bond. Now I'm purchasing a bond. In question number 7, I was issuing a bond at its fair value of 1,000. So my entry would have been investment account debit to bank. It is at fair value. The bond carries interest at 4.7% of its face value, and the interest is received at the year end. The bond has a maturity of 5 years and is redeemable at its face value of 1250. So the face value is 1250, and hence if I were to find the coupon is 1250 into, I think 4.7% will come to around 58 point something. If I round off, this is around $59. The fair value of the bond at the year end is 1060. So you have been given the fair value. The exchange rate on the date of the transaction and at the year end is rupees 40 and rupees 45 respectively. So when I purchase the bond, the rate is 40, but at the end of the year it is 45. The weighted average exchange rate for the year is 42. So average rate is also given. Opening rate 40 when I am purchasing, closing rate 45, average rate is 42. The entity has determined that it is holding the bond as a part of the investment portfolio whose objective is met by holding and by selling, which means the appropriate classification will be FEOCI. The purchase USD bond is classified as FEOCI, that is correct. The bond results in an effective rate of around 10%. ER is given, so we'll have to take that. Calculate the gain or loss to be recognized in the P&L and the OCI for year 1. Also pass the journal entry to recognize the gain or loss on the above. Remember, this is only for the purpose of gain or loss. They are asking you to pass. Now over here, you have purchased the bond in dollars, and hence your opening balance will be $1,000. effective rate at the rate of 10% will be an interest of $100. Coupon that I'm receiving is $59, and hence the closing balance will possibly be around 1041. However, this bond is to be recorded at FVOCI, and hence the closing fair value will be 1060, and hence there will be a fair value gain of around $19. This $19 will have to be converted into rupees like everything else. But this $19 is a fair value gain, and hence it will go to the OCI, fair value reserve. It's not a foreign exchange gain. It's a fair value gain from 1041 to 1060. Now, every number if I had to convert, 1000 will be converted at 40, 100 will be converted at 42, 59 will be converted at 45, closing balance of 1041 also at 45. And hence if I were to take this at 40, 42, 45, and hence there is a foreign exchange gain or loss. Remember, this is on a monetary item, and hence this will be taken to the P&L. You have to resist the temptation to take this to OCI. You will say that bond ka gain or loss is going in OCI, so this will go to the OCI. No, this is a gain or loss on a monetary item, and monetary item gain or loss always, without any exception, will go to the P&L. So this is a foreign exchange gain going to the P&L. Now your closing amortized cost will be at 45. Now you want to find if there's a fair value gain or loss. Well, 1041 was converted to 45, 1060 is also converted to 45, and hence a balancing figure of 19 converted to 45, it is 855. Where will this go, sir? This will go to the OCI. So if I had to pass the journal entries, investment account debit to forex gain in the PNL of 5300 goes to the PNL because it is a gain on monetary item. Whereas if I look at the 855 gain, this is a fair value reserve which is going into the OCI. And this kind of takes care of the important questions from the foreign currency transaction section as well as the functional currency section. Next, what you go to is the last part over here, which is on foreign operations. Now, what do you mean by foreign operations? These may be foreign branches, foreign subsidiaries, foreign joint ventures, where the functional currency is different from that of the parent. So, you might have a foreign office domiciled in a foreign country. Merely because it is domiciled in a foreign country does not mean it is a foreign operation. If it is largely dependent on you, proportion of transactions are very high, it is largely dependent on you, you are financing that, then it is like a dependent branch, in which case their functional currency will be the same as that of the parent's currency. However, if you look at Tata Motors, which is an Indian company, JLR, which is a UK company, and JLR finances its own operations, it is not largely dependent on Tata Motors, and the proportion of transactions between the two is relatively less. Now, JLR's functional currency is the primary economic environment of JLR, which is a UK environment, for example, in which case their functional currency will be the pounds, our functional currency will be the rupees. And now, at the end of the year, when Tata Motors has to prepare CFS, then it has to translate JLR's financial statements into rupees for the purpose of its foreign currency consolidation. Now, at what rate should you translate? Remember, this is very different from foreign currency transaction. If Tata Motors did not have JLR and it had to buy an asset in the UK, for that it will have to actually remit rupees, convert it into pounds and then invest it, and hence it is exposed to actual foreign exchange gain or loss which would go to the PNL. However, if JLR, which is largely an independent operation, has a receivable in pounds, it will usually use it to pay off its liabilities, etc. in pounds, and hence this money will not generally be repatriated back to the rupees, and hence the foreign currency gain or loss, if any, will be on paper, and hence if there's a foreign currency gain or loss on this mere translation for the purpose of consolidation, usually we park it into an account called as Foreign Currency Translation Reserve, FCTR, which is a part of a reclassifiable OCI, and the balance in this FCTR will remain in the OCI till the time you dispose of the foreign operation. When you dispose of the foreign operation, the balance in the FCTR will be transferred to the profit and loss account. It's a part of a reclassifiable OCI. But what are the rates that we will use for the purpose of conversion? All incomes, expenses, that is basically profits that are earned during a period, should be converted at ideally the rate prevailing on each of those dates or the average rate. Now, JLR must have prepared everything in pounds. Now at the end of the year, you say you convert everything into rupees. Now I'll have to go back and convert each expense, each income at the rate on that date. So generally, instead of doing that, people take the average rate. So over here, incomes and expenses will be as on either on the rate of date of transaction. Otherwise, you can even take the average rate. However, when you look at converting assets and liabilities, let's say the foreign branch had various assets and liabilities, this will be converted at what rate? So they will be converted at the closing rate. Sir, monetary items you are aware at the closing rate, but even non-monetary, yes. This is something that you have to drill in your mind, that even the non-monetary items will be converted at the closing rate. Sir, why? Well, because over here, this is a gain or loss which is arising 0.1 on paper. It is not a real gain or loss. Sir, when it will it become real? It will become real when the entire JLR is sold to someone. But when you sell JLR, will you just sell the monetary aspects? No. Will you sell the entire operation including monetary and non-monetary? Yes. And hence, to correctly find the gain or loss, we will take the monetary and non-monetary both at the closing rate. So all monetary as well as non-monetary items are at the closing rate. Sir, but non-monetary should be at the historic rate? Yes. That is if it is a foreign currency transaction directly. However, if it is a foreign operation in which the non-monetary item is appearing, then you will convert it at the closing rate, because you want to find the gain or loss on the entire operation and not just the monetary part of the operation, because when the money comes back to India, the entire operation, when it is sold, the entire compensation for monetary and non-monetary will come, and hence even non-monetary, you have to drill this in your mind, only for foreign currency translation will be converted at the closing rate. All the more, the standard has comfort of taking this at the closing rate, because the gain or loss is not currently going into the P&L. It is parked into a foreign currency translation reserve. Remember, this is a principle for assets and liabilities. Share capital is not an asset, is not a liability. And hence, share capital, own equity cannot be remeasured. So, share capital will be at the historical rate. This is the rate as on the date of acquisition. Like JLR may be incorporated in the 1950s. However, Tata Motors acquired a controlling stake in the 2010. Then, your equity share capital will be converted on the rate on the date of 2010, and after that there will be no remeasurement. Own equity cannot be remeasured. Further, reserves which were existing as on the date of acquisition, that is 2010, are actually purchased, and hence they will also be converted at the rate on the date of acquisition. After that, in the year 10, 11, 11, 12, 12, 13, 13, 14, whatever profits are earned, these profits will be consolidated, and hence they will be converted at the closing rate. Long story short, monetary assets, non-monetary assets, monetary liabilities, non-monetary liabilities, all of them will be converted at the closing rate. However, share capital will be converted at the rate on the date of transaction, acquisition, pre-acquisition reserves also at the rate as on the date of acquisition, and post-acquisition reserves at the average rate, because after acquisition, incomes and expenses will be converted at the average rate. So over here, assets and liabilities, both monetary and non-monetary at the closing rate, equity capital on the rate on date of acquisition, reserves pre-acquisition at the rate on date of acquisition, post-acquisition reserves will be at the average rate. And if there's a difference, now how will you calculate this difference? Well, the trial balance or the balance sheet will be tallying in the foreign currency. However, if you multiply something by the average rate, something by the closing rate, something at the rate on date of acquisition, will it tally in rupees? No. And hence the balancing figure over here will be the foreign currency translation reserve, or FCTR, and this FCTR over here will be a part of a reclassifiable OCI. So, after applying the principles, the balance sheet of the subsidiary in parent currency may not tally. Why is this difference arising? Because different exchange rates are applied, and hence they would be accumulated using FCTR. It's a part of a reclassifiable OCI and will be transferred to the P&L at the time of disposal of the foreign operation. Okay, there are certain special adjustments which can arise at the stage of consolidation, like when you are having a holding company and a subsidiary company and you are consolidating. Institute has not asked you a full-fledged question ever on a foreign currency full-fledged consolidation, but if it is asking you, you should be aware. Like goodwill is also a non-monetary item. Is every non-monetary item of the subsidiary converted at the closing rate? Yes, and hence goodwill will also be converted at the closing rate. Now a student says, this sir, goodwill remains the same. Yes, the goodwill in the foreign currency will remain the same. So you will determine the goodwill in the foreign currency and then convert it at the closing rate in order to find the appropriate goodwill balance in rupees. And this goodwill can be different in rupees. Like land can be measured using the cost model. Land in dollars will remain the same, but when you convert it, translate it into rupees, there can be a difference. In a similar way, goodwill in dollars will remain the same, but when you translate it into rupees, there may be a gain. All of these gains will be shown in the FCTR. Now, in the consolidation process, by and large, if it's a foreign subsidiary, the process will remain the same. Just that before you start consolidation, you will first have to convert the subsidiary's trial balance and balance sheet into rupees at the applicable rates, find the balancing figure FCTR. Then you prepare the consolidation workings in the usual manner, but while you are calculating goodwill, calculate goodwill in the foreign currency, that is dollars, and then convert it into rupees at the closing rate. Further, there may be analysis of FCTR which is needed, which is appearing in the subsidiary's balance sheet. This FCTR which appears in the subsidiary's balance sheet will always be post. Why? Because on the date of acquisition, there will be no FCTR. All items, assets, liabilities, even share capital and pre-acquisition reserves on the date of acquisition will all be converted at the rate as on the date of acquisition. So there is no FCTR as on the acquisition date. However, later there will be an FCTR. So this FCTR is born after the acquisition date, and hence this is post-acquisition. Again, this is on assets and liabilities of the subsidiary which belongs to parent and NCI both, and hence will be attributable to parent and NCI both. However, when you look at foreign currency gain or loss on goodwill, this foreign currency gain or loss on goodwill will be attributable to parent only if it is partial goodwill method, will be attributable to parent and NCI both if it is a full goodwill method. So that is regarding consolidation. Other consolidation adjustments that you need to remember over here is, what if there is an unrealized profit or loss on an intercompany sale, like there may be an upstream or a downstream sale. Over here, remember, profit is based on the rate as on the date of the transaction. So when you sell goods, ideally you will take the rate as on the date of the transaction, and hence when you want to find the unrealized profit, you will take profit is for the period. Balance sheet items are as on date, but if you want to eliminate the unrealized profit, you will find the profit in dollars. For example, convert it into rupees at the rate as on the date of the transaction, not at the closing rate, and then you will use that for elimination, that is P&L account debit to, let us say, inventory, but that will be converted at the rate as on the date of the transaction. Further, what might happen is there may be intercompany receivables and payables. If there's an intercompany receivables and payables, you will have to eliminate it. However, in the parent's books, maybe the receivable is appearing, in the subsidiary books there's a payable, but let us say these are in different currencies. So at the end of the year, you will convert them, translate them back at the closing rate. This is not income and expenses, this is asset and liability. You translate it back at the closing rate, and the debtors and creditors will knock off each other. However, it is very much possible that you have sold goods and you have money receivable. You are an Indian company and the money receivable is, for example, in rupees. The subsidiary is a US company. For them, the money is payable, but it is payable in rupees, and hence this is a foreign currency transaction. So the subsidiary will record a gain or loss, and this gain or loss in their individual books will be there and will continue to appear even in the CFS. So just remember that merely because you are eliminating the assets and liabilities does not mean the foreign exchange gain or loss, if any, has to also be eliminated. The foreign exchange gain or loss, if any, will continue to appear. Now over here, before you proceed further and go into more detailing, we can probably try a few questions that will give you a better understanding. So over here, for example, if I have question number 9, and then a more important question, I think, is question number 17, which is there behind. Infotech Global has a functional currency of USD and needs to translate its financial statements into the presentation currency, that is $. The following statement of financial position prior to translation is available. So there is PP, which is actually non-monetary. Receivables, monetary. Issued capital, already given. Opening retained earnings, already given. Profit for the year. Accounts payable and accrued liabilities. Translate the statement of financial position of Infotech Global into $, ready for consolidation. Share capital and opening retained earnings have been pre-populated. Perfect, so I don't need to worry. Otherwise, this would be at the rate as on the date of acquisition. Prepare a working of the cumulative transaction reserve. Additional information given is rate at the beginning is 1.22, average rate is 1.175, and rate at the end of the year is 1.13. Now I have to do translation, which means all items will be converted at the closing rate, all assets and liabilities. Even if it is PP, well, over here it is in USD, I need to convert it to $, so I'll have to divide it by 1.13. Receivable divided by 1.13. Issued capital and retained earnings is already there. The profits will be at the average rate, and hence you will divide it by 1.175, and the accounts payable and everything will be at 1.13 only. Now if I take all of these, everything, you can see 1.13, it is just that this is 1.175. Everything else is 1.13. Now if I were to take the balance sheet, now balance sheet is not tallying, and hence the difference, if any, will be attributable to FCTR. Alternatively, FCTR can also be calculated by using the net worth, but otherwise if you can calculate it directly, this is perfect. So what will you do? You will apply the applicable rates, convert everything into $, all assets, liabilities at the closing rate, share capital at the historical rate, this is already given in here, opening retained earnings already given, profit during the year at the average rate. So the balancing figure, if any, is to be attributable to FCTR. Now more important than this, and it has more coverage, would be question number 17. You can mark this as important. Over here, this is an MTB question, but this has a lot of things. If you see over here, what is asked as an accountant of PQR India, you are required to do the following. In the separate financial statements, explain the principle of monetary and non-monetary, and based on this principle, bifurcate the line items in the trial balance into monetary and non-monetary. So this will test your monetary non-monetary application. Translate the trial balance of PQR from INR to GBP. So you'll have to convert it from INR to GBP. Now over here you have been given general information that PQR is based in London, has pound as a currency. On 1st April, PQR incorporated an Indian company as a wholly owned subsidiary. PQR will be engaged in trading of some items. Shares of PQR India have a face value of 10, amounting to total of 500 crores, and were issued to PQR Holdings on 1st April 11. So this is the rate on the date when the shares were issued. PQR has adopted Ind AS from incorporation and concluded the functional currency is a rupee. That's fine. Following the summarized trial balance of PQR India as on 31st March 12, being the reporting date. Okay, all of these are given in rupees crores, but I'll have to translate it back to pounds. Now, share capital. This is a non-monetary item and will be translated at the rate on 1st of April when it is issued. If you see, 1st April, this is 0.123. Okay, securities premium. This is also a non-monetary item, but this will be on the same date when the shares were issued. So this will be, let's say, 0.0123. This is also 0.0123. Return earnings. This is the first year of the company. So this will be converted at the average rate. If I go to see, the average rate is 0.0116. Okay, again, this is non-monetary. It is not contractually fixed or determinable amount of cash. Long-term borrowings, monetary. This will be at the closing rate. Are you in the closing rate? On 31st March, 0.0109. So this will be at the closing rate, 0.0109. As a deferred tax liability, this is a bit off. Deferred tax liability is a non-monetary liability because you don't have a fixed or determinable obligation. The government cannot sue you for paying the deferred tax liability. They can sue you for the current tax liability. So this is non-monetary. But non-monetary items for translation are still converted at the closing rate, 0.0109. Acha, current income tax payable, monetary. Import duty payable, again monetary. Employee benefits payable, monetary like salary payable. Sundry debtor payables, monetary. Can I say all of these are going to be converted at the closing rate only? Acha, then you have PP. Now PP is purchased. If you go to see on the next page, PP was purchased on 30th April. Then you have software. Software was purchased on 5th of May. And then there is inventory. Was purchased on 15th March. Acha, you have been given the date rate on 30th April, 5th May and 15th March. These would be historical rates, but non-monetary items as well, you will convert at what rate? Sir, because this is translation, we will convert everything at the closing rate. So over here, these are non-monetary items. However, even they, for translation, will be converted at the closing rate. All of these will be at the closing rate only. Cash and bank balance, well, this is a monetary item. Trade receivables, again monetary items. Acha, allowance for bad debts. Remember, trade receivables के अंदर से allowance for bad debts come, and hence like depreciation comes out of PP. The rate at which depreciation is recorded, the rate at which PP is recorded. In a similar way, allowance for bad debts comes out of debtors, and hence the rate at which allowance for bad debts will be recorded will be the same rate at which the debtors are recorded. So this is also a monetary item because this comes out of debtors, and hence all of these are also at 0.109. And hence if I convert all of this, as you see, share capital, return earnings, all of these are monetary items and they have slightly different rates. Other than that, there's deferred tax liability, which is non-monetary, but again at the closing rate. PP, software, inventory, they are actually non-monetary, but still at the closing rate. And allowance for bad debts is monetary, again at the closing rate. Acha, the balancing figure, if any, will be taken as FCTR, and this is a balance in the FCTR. So this is pertaining to question number 17. Now 18 is also similar. We'll probably review the other questions. So this takes care, in my opinion, of all the most important questions. Other than that, let us say over here, there is a situation where I was discussing regarding foreign currency gain or loss. Now the functional currency of parent B is a USD, while that of the subsidiary is a Euro. P sold goods having a value of $100 to S. So that is a sale of P to S in dollars. Now dollars is parent ke currency, and the exchange rate was USD 12 equals 2 euro. At the year end, the amount is still due. So there is a payable receivable still, and the exchange rate will be 2.2 euros. How should the exchange difference be accounted for in the CFS? Now in the books of the parent, I will just say debtor account debit to sales. This is in my own currency, no remeasurement. But in the books of the subsidiary, it will be purchase account debit to creditors at 200 euros because that is the currency. Now at the end of the year, subsidiary has to pay $100, which is now worth 220 euros, and hence there's a forex loss of 20 euros to be recorded. Now these creditors of 220 euros will be translated back at the closing rate. So 220 euros divided by 2.2 will come to $100. And this $100 of payable and $100 of receivables will be eliminated. However, this loss of 20 will still continue to appear because my debtors creditors are eliminated, but this 20 ka loss will still continue to appear. Okay, now one more question that we have maybe in let us say the consolidation, if we can take that over here, would be a very interesting question. If I can just pull it up on your screen. Question number 36, I believe. Okay, so if you review question number 36 on your screen, just a minute. 35. Okay, this is also an important question. Global Limited, an Indian company, acquired on 30th September 70% of the share capital of Mark, an entity registered as a company in Germany. The functional currency of Global Limited is a rupee, and the financial year end is 31st March 2012. Okay, so I've acquired 70% stake, so I've acquired control on 30th September. The fair value of the net assets of Mark was 23 million euro, and the purchase consideration was 17.5 million euro on 30th September. So if I were to calculate goodwill, this is 17.5 of PC plus NCI minus net assets. This is 23, and net assets are 23 into 30%. 6.9 will be the NCI, and hence on 30th September, if I had to calculate the goodwill, this will be, I believe, 1.4 million euros. The exchange rate on 30th September was 82 per euro, and then on 31st March 12 was 84. What is the value at which the goodwill has to be recognized in the financial statements on 31st March 12? Now, goodwill in euros is fixed. However, goodwill is a non-monetary item, and hence it will also have to be converted at the closing rate, and hence at 84, and hence it will be 117.6. 117.6. This is point number 1. Point number 2. Mark sold goods costing 2.4 million euro to Global for 4.2, which means there's a profit of around 1.8 million recorded in the books of Mark during the year ended 31st March 12. The exchange rate on the date of the purchase by Global was 83. You'll have to record these at the rate on the date of sale. This is 83, and on 31st March 12 was 84. The entire goods from Mark have been unsold as on 31st March 12. Determine the unrealized profit. Profit is as on date. This is maybe 4.2 minus 2.4, that is 1.8, and this 1.8 into rupees 83 per euro, and hence this is 1.8 into 83 will come to 149.4. This is your total unrealized profit that needs to be eliminated while preparing CFS. The year end maybe 31st March 84. However, profit is as on date, and hence 149.4 of profit should be eliminated. Are we clear with this? Aja. Now there is another important question, that is question number 16, which has also come on similar lines in the exam. We'll review that. Okay, so go to question number 16 over here. So let us review this question. M has engaged in the business of manufacturing bottles for pharmaceutical companies and non-pharma companies. So M is making bottles. It is a wholly owned subsidiary G, which is engaged in the business of pharmaceuticals. So it is making medicines. G purchases the pharma bottles from its parent company. So M, that is a parent, is selling to G, that is a subsidiary. The demand of G is very high and the operations of M are very large, and hence to cater to the shortfall, G also purchases a bottle from other companies. So that is general information. Purchases are made at competitive prices. M sold bottles to G for 12 lakh euros M is selling at 12 lakh euros on 1st of February 2011. The cost of these bottles was rupees 830 lakhs in the books of M at the time of sale. So if I look at M, in M's SFS, you will have these bottles which are having a cost price of 830. But the selling price over here is 12 lakh euros. Okay. At the year end, 31st March 11, all of these bottles were lying as closing stock of G. So in the books of G, these bottles will be lying as unsold, maybe at whatever is the balance. Euro is a functional currency for G, whereas rupee is a functional currency for M. So when I look at M, the currency is a rupee. When I look at G in its SFS, the currency is a euro. So when I look at M will have to convert the 12 lakh euro of sale into rupees at the prevailing rate as on the date of the transaction. The following additional information is available. Rate on 1st February 83, 31st March is 85, which means M would convert this at the rate of 83, that is around 996 lakhs. So in the separate financial statements of M, 996 will be the sales, 830 will be the cost, and hence there will be a profit of around 166 rupees. This will be recorded in the books of M. This is on the sale of these goods. Exchange rate at the end of the year is 85. Okay, so in the books of M, provide the accounting treatment for the above in the books of M and G. Also show the impact in the consolidated financial statements and support your answer by journal entries wherever necessary in the books of M. So over here, when we do this working, what will be there? Well, we will pass the journal entries. So first we'll go to the SFS of M. In the SFS of M, there will be a sales entry. We don't know whether there is cash sales or credit sales. Let us assume that this is a cash sales, in which case in the books of M, if you go to see, the entry will be receivable, that is from G account debit to sales on 1st of February in the SFS of M, where rupee is a currency. This is bank account debit if money was received, or G account debit if the money was yet to be received. To sales, this is 996. At the same time, there will be a COGS to inventory of around 830, and hence there will be a profit of 166 in the books of M. When I go to the books of G would say that euro is my currency and the invoice is denominated in euros, and hence on 1st February the entry will be purchase account debit to bank if it is paid, or M if it is unpaid, at 12 lakh euros. So this is purchase account debit to bank, or M as the case may be. This is 12 lakh euros. Now at the end of the year, in my separate financial statements, I will have to remeasure, for M at least, I'll have to remeasure the receivables which are 12 lakh euros at the rate of 85. Earlier, the receivables were recorded at the rate of 83, and hence there will be a 2 rupee gain in the books of M. 2 rupees into 12 lakh euros, that is 24 lakh. In rupees will be the foreign exchange gain which will go to the P&L account. This is G account debit, 24 to forex gain in the P&L, that is 24. Remember, in the books of G, there will be no foreign exchange gain or loss because the transaction is in the currency of G. Now, by the end of the year, the balance sheet and trial balance of G will have to be restated in M's currency, and among other things, the payables which are at 12 lakh euros will have to be restated at the closing rate. So this will be in the books of G. You will translate the payables for consolidation. This is 12 lakh euros. 12 lakh euros will be translated at 85, and hence this will become 1020. Now, if I compare this with M's in books of M, the receivable, that must be 996 plus another 24, and hence this will also be 1020, and hence there will be an elimination over here. This 1020 and 1020 will be eliminated. In the CFS, payable account debit to receivable will be eliminated at 1020. Now the problem is unrealized profit. Now, as per Institute Solutions, inventory over here is a balance sheet item, but profit is a P&L item. Now, if I look at this inventory in the books of M, well, this inventory will appear. So this inventory will appear in the books of G. However, this inventory, if I look at the consolidated financial statements, will have some unrealized profit of around 166, and hence you will eliminate the exact profit that was recorded. Profit elimination will be of around 166. So your entry will be P&L account debit to inventory at around 166, and this will take care of question number 16, which is one of the important questions. Okay, other than that, there is a few other adjustments when you look at, for example, your consolidation. A special adjustment over here is usually when we have loans that we give. These are foreign currency loans. these are monetary items. The gain or loss will go in the P&L account. However, if these loans are permanent in nature, like these are irredeemable items or these are loans where settlement is not planned, then the foreign exchange gain or loss in the SFS will still be in the P&L. However, when I consolidate, this money is never going to be remitted back. So generally, when I give a loan or when I do a credit sale, the money is likely to come back, and hence when the money comes back, there will be a foreign exchange gain or loss. However, if there is a permanent investment in a foreign operation, which is in the form of a loan where settlement is not planned or an irredeemable instrument, then as per IND AS 21, over here what will happen is, we will say that in your SFS, you can continue to show these gain or losses in the P&L. However, in the CFS, if this gain is not really going to happen, then you will reclassify it to FCTR. So over here, foreign exchange gain or loss on intercompany monetary items, if settlement is planned like debtors, term loans, then in the SFS as well as in the CFS, your gain or loss will be in the P&L. Like in the last problem over here, in the SFS of M, there was a foreign exchange gain of around 24. This will continue even in the CFS because I believe that from G money will be received, and hence in that case the euros that I receive will be worth 24 more in terms of rupees, and as a result there is a gain which will be in the P&L. However, if this was not a loan, if this was not a credit sale, but if this was a loan where settlement was not planned, sir, but if nothing is going to be assumed, settlement is planned. However, if over here settlement was not planned, then in my SFS, I will still say M and G are two separate entities, and hence the gain will go in the P&L. But when I CFS, I say that this money is not going to come back, and hence in my CFS, I will reclassify this gain of 24 into the FCTR if it was given that the settlement will not be planned. So in the SFS, this is P&L. In the CFS, you will reclassify to the FCTR as a part of OCI. If nothing is going, we'll assume that the settlement is planned. Now, another thing that we'll have to remember is what happens to the FCTR in general. Well, FCTR is a part of a reclassifiable. OCI will be transferred to the P&L on the happening of certain events, that is disposal of stake. Now, you might be holding a 80% stake in the subsidiary and you might be selling 60%, in which case you're losing control. If you're losing control, now you might still be retaining 20% stake. However, all the assets and liabilities of the subsidiary will be derecognized, and hence the entire FCTR, which is attributable to you in your consolidated P&L, will be transferred to the P&L account. Your entry will be FCTR account debit to the statement of P&L. However, what if I dilute only 20% stake? I have 80%, I sell 20%, so 60% still remains. In which case, over here, my assets and liabilities are still consolidated. However, 20% of that is attributable to the NCI, and hence you will not transfer the entire FCTR. In fact, you will just readjust and say that earlier out of the FCTR we had an 80% stake, now we have a 60% stake, and hence 20% of the FCTR will now be attributable to the NCI. So over here, if there's a stake sale where there's a loss of control, the entire FCTR, which is attributable to the parent share, will be transferred to the P&L. However, if there's no loss of control, then the part of FCTR to the extent of stake sale which is creating the NCI will be transferred to the NCI. Okay. Next, you have a few additional points. The additional points over here will be, is it possible that once you decide a functional currency at a later date, there may be a change? Well, why not? If there's a change in the primary economic environment, then the functional currency might change. Remember, this is not a change in accounting policy. It is not even a change in accounting estimate. It is a change in fact. Like when you have PP for own use, if you change the use, it becomes an investment property, then you reclassify. In a similar way, earlier if I was operating in India, catering to Indian students, all expenses in India, then my currency will be rupees. But if later I decide to change my functional currency because I'm changing the environment in which I'm operating, then that is a change of fact, and hence that is not a change in accounting policy. Further, another case is sometimes you have to translate the financials because there is consolidation needed. However, sometimes there may be no consolidation. Let us say there is a company like Naukri.com which is operating in India. However, it is listed on the US stock exchange, and as a result over here, it wants to present its financials in dollars. In which case, can it translate its financials from rupees, which is its functional currency, to the dollars for the purpose of presentation? Yes, the principles will be the same. Incomes and expenses will be converted at the average rate. Monetary assets, non-monetary assets and liabilities will be at the closing rate, and equity share capital at the historical rate over here, and the balancing figure, if any, will be going to the FCTR, foreign currency translation reserve. The another special case over here pertains to IND AS 101, that is first time adoption. If in case of first time adoption, you have a choice of let's say in the older standards as per AS 11, you might have a foreign currency monetary item transition difference account. If you want to continue, you can continue the same, or you can adopt IND AS 21, that is take the gain or loss on long-term loans to the P&L. If you decide to continue to adopt para 46A of AS 11, that is continue with the foreign currency monetary item transition difference account, then as per IND AS 21, it says that for those loans where the choice was taken as per IND AS 101, you can continue to record the foreign currency gain or loss on long-term loans in the foreign currency monetary item transition difference account. This is only and only for those loans which were existing on the date of transition, and a choice to continue the special treatment as per AS 11 was permitted over here. If you have done IND AS 101 and if you remember the AS 11 treatment, well and good. Otherwise, this is something that you will do separately along with AS 11. So that by and large takes care of IND AS 21. I hope you have got a reasonably good amount of clarity and understanding for this standard. If yes, please do press the like button, means a lot to us, and do share and subscribe this with your friends to whom this may be helpful. I'll see you soon with more such videos, and if you want a specific standard or a specific topic that you kind of want me to cover in the near future, please do put that in the comments box, and I'll try to do the topic which gets the maximum comments as the earliest. Okay, so that should be it. Thank you very much for your time, and I'll see you soon with more videos. Till then, good luck, goodbye, and keep studying.